Have you noticed something strange happening in the stock market lately? For the past 3 years, Wall Street treated artificial intelligence like a magic money machine. Investors believed AI would create endless profits and that tech companies could grow forever. But behind the scenes, something much bigger and much riskier has been happening. The same companies leading the AI revolution are now quietly borrowing enormous amounts of money just to keep the AI dream alive. We are talking about up to $1.5 trillion in debt being raised to build massive AI data centers. And lately, I have been seeing something interesting. Creditors are starting to get nervous, which made me ask a question that most investors are not asking yet. What if the biggest risk in the AI boom is not the technology, but the debt required to run it? And if you invest in index funds like most Americans do, then this story directly affects your money. So today, I want to walk you through what is actually happening behind the AI boom, and why the next phase of this revolution may look very different from the hype we have been watching for the last 3 years. Before we get into it, make sure you subscribe to Dave Invests Smart, because on this channel I break down the biggest financial trends shaping our investments, and I try to explain them in a way that actually makes sense. Now let me tell you what I think happened during the last few years. The AI boom started in what I call the imagination phase. This is the phase where a new technology appears and everyone suddenly starts imagining a futuristic world powered by that technology. That is exactly what happened when generative AI exploded into the mainstream. When ChatGPT appeared, it felt like something from the future had suddenly arrived in the present. Within months, every major tech company was talking about AI strategies. Microsoft invested billions into OpenAI. Google rushed to build its own AI systems. Amazon started positioning its cloud business as the backbone of AI infrastructure. And NVIDIA suddenly became the most important chip company on the planet because its GPUs power almost every advanced AI model. And of course, investors reacted the way investors always react when a new technological revolution appears. Stock prices went crazy. NVIDIA became one of the most valuable companies in the entire world. Microsoft briefly overtook Apple as the most valuable company in the market. The Nasdaq surged, and suddenly everyone felt like we were witnessing the next great technology wave. But here is something I have learned from watching markets for a long time. The imagination phase of any technology revolution is always the easiest phase. Everyone talks about possibilities. Everyone talks about how the future will look. But nobody really talks about the cost of building that future. That is where things start getting interesting. Artificial intelligence is not just software running in the cloud. AI requires an insane amount of computing power. Every AI model needs thousands of powerful chips running together inside massive data centers. Each of those chips can cost tens of thousands of dollars. And a single AI data center can cost billions to build. When I first started digging into the numbers, I was honestly shocked by the scale. Analysts now estimate that the largest tech companies in the world could collectively spend more than $1 trillion building AI infrastructure over the next decade. Some estimates even push that number close to $1.5 trillion when you include power systems, cooling equipment, networking hardware, and land for the facilities. And here is the detail that most people miss. A lot of this money is not coming from profits. It is coming from borrowing. In other words, the companies leading the AI revolution are taking on massive debt to build the infrastructure required for artificial intelligence. Now, to be fair, this is not automatically a bad thing. Companies borrow money all the time to build infrastructure that will generate profits in the future. Railroads did it. Telecom companies did it. Energy companies do it constantly. But here is where I think the psychology of the market becomes fascinating. During the hype phase, investors do not worry about debt because everyone assumes profits will arrive quickly. But now, we are moving into the execution phase of the AI revolution. And the execution phase is where companies actually have to prove that the hype will translate into real money. Let me give you an example. Think about NVIDIA. NVIDIA has become the superstar of the AI boom. Its chips power the majority of AI systems across the world. Demand for those chips exploded, and Nvidia's revenues surged at a speed that shocked even seasoned analysts. Investors piled into the stock, and suddenly Nvidia became one of the largest companies on the planet. But when a company grows that fast, something else happens that most retail investors do not notice. It becomes a huge part of the entire stock market. Today, companies like Nvidia, Microsoft, Apple, Amazon, Alphabet, and Meta represent a massive portion of the S&P 500. And that has a very important implication for ordinary investors. If you own an index fund inside your retirement account, then you are already heavily invested in the AI boom, whether you realize it or not. Index funds are supposed to diversify your investments across hundreds of companies. But when a few companies become extremely large, they start dominating the index itself. So if those companies rise, the entire market rises with them. But if something goes wrong, the entire market can feel the impact. And that brings me back to the debt problem. Building AI infrastructure is unbelievably expensive. Data centers require massive buildings full of specialized hardware. They consume enormous amounts of electricity. They need complex cooling systems to prevent chips from overheating. And they must be connected through high-speed networking infrastructure that cost billions more. When I started researching this industry, I realized that artificial intelligence is not just a software revolution. It is also a physical infrastructure revolution. And that changes the financial equation. For decades, the magic of Silicon Valley was that software companies could scale globally without building expensive infrastructure. Once you wrote the code, you could distribute it to millions of users with relatively low cost. And AI breaks that model. Every new AI user requires computing power. Every AI query consumes energy and hardware resources. And as usage grows, the infrastructure must grow with it. That is why the biggest tech companies are racing to build data centers faster than ever before. But this race is also creating pressure on the financial system supporting it. Credit markets are starting to watch this spending very closely. Lenders want to know how quickly these companies will generate returns from their massive AI investments. Because building trillion-dollar infrastructure is one thing, turning it into consistent revenue is another. And this is where history gives us an interesting lesson. During the late 1990s internet boom, telecom companies borrowed enormous amounts of money to lay fiber optic cables across the world. Investors believed the internet would explode in popularity, and those networks would become extremely profitable. The technology prediction was correct. The internet did explode. But many of the companies that built the infrastructure went bankrupt before the profits arrived. Now, I am not saying that will happen with artificial intelligence, and AI is already creating real productivity improvements across many industries. Businesses are integrating AI tools into software development, marketing, customer support, and data analysis. But from an investment perspective, timing matters. If the market expects AI profits to arrive immediately, but the reality takes longer, then stock prices can become volatile while expectations adjust. And that is exactly why I believe we are entering a very important stage of the AI story. The imagination phase is ending. The execution phase has begun. Investors are no longer satisfied with big promises about the future. Now they want to see clear evidence that AI services can generate sustainable revenue at the scale required to justify these enormous infrastructure investments. They want to see companies paying serious money for AI tools. They want to see consumers integrating AI into everyday life. They want to see productivity improvements translating into economic growth. Until that happens, the entire AI ecosystem is operating largely on expectation. And expectations can shift quickly in financial markets. Now, here is the part that I personally find most interesting as an investor. This moment creates both risk and opportunity. On one hand, the concentration of big tech companies inside the stock market means many portfolios are more exposed to the AI narrative than people realize. If those companies experience volatility, the ripple effects could spread across the entire market. On the other hand, technological revolutions also create enormous long-term wealth when the winners eventually emerge. Think about the internet again. Many early internet companies failed, but the companies that survived became some of the most valuable businesses in history. Artificial intelligence could follow a similar path. Some companies will dominate the infrastructure layer. Others will dominate the software applications built on top of that infrastructure. And entirely new industries may appear that we cannot even imagine today. But the transition from hype to profitability is rarely smooth. That is why I try to focus less on short-term excitement and more on understanding the underlying economic forces driving these trends. Right now, the biggest force shaping the AI revolution is not the algorithms. It is the massive capital investment required to power those algorithms. Data centers are being built across the United States, Europe, and Asia. Energy companies are negotiating huge power contracts to support AI workloads. Semiconductor manufacturers are expanding production to meet demand for advanced chips. This is one of the largest infrastructure expansions the technology industry has ever attempted. And like every infrastructure boom, it will create both incredible winners and painful losers. Which is exactly why I believe investors should pay attention to this shift from imagination to execution. Because when the narrative changes, the market can change very quickly. And the investors who understand the story early usually have the biggest advantage. If you found this explanation helpful, make sure you subscribe to Dave Invests Smart, because my goal with this channel is simple. I want to help you understand the deeper psychology and economics behind the financial headlines, so you can make smarter investment decisions while everyone else is just reacting to the news.